Welcome back to Smart Stock Sam. Today we're diving into one of the wildest market disconnects we are seeing this year. Imagine a company that just crushed earnings, grew revenue by 70%, and flipped from massive losses to over $500 million in profit. Sounds like a rocket ship, right? Well, the market just hit the eject button and sent it plummeting nearly 40%. We're breaking down Reddit's post-earnings reality, analyzing whether this dip is a generational buying opportunity or a value trap that'll burn your portfolio. Stick with me, because the hidden metric we'll uncover in next few minutes completely changes the risk equation for 2026. So let's talk about the elephant in the room. How does a company deliver what Wall Street calls elite execution and still watch its valuation implode? The answer lies in understanding the fundamental transformation that Reddit just pulled off versus the technical breakdown that's currently destroying shareholder value. When you look at fiscal 2025, Reddit didn't just grow, they completely reinvented their business model. We're talking $2.2 billion in total revenue, a 69% year-over-year explosion. But here's what separates the amateurs from the pros. Revenue growth means nothing if you're bleeding cash. Reddit swung from a net loss in 2024 to a $530 million profit in 2025. Their adjusted EBITDA surged over 180%, proving this isn't some hype-driven growth story anymore. This is a high-margin profitability machine that the market is currently pricing, like it's on life support. Now you're probably asking yourself, what's actually driving this revenue monster? Is it just user growth, or is something deeper happening under the hood? Here's where it gets interesting. Reddit's daily active users grew 19% to over 121 million, which is solid, but not revolutionary. The real story is monetization velocity, specifically international monetization. Their average revenue per user internationally surged 38%. Think about what this means for a second. Reddit is still in the early innings of figuring out how to extract maximum value from their global audience. The gap between US and international ARPU represents a multi-year runway for revenue expansion that most analysts are completely ignoring in their panic selling. But here comes the plot twist that sent the stock into free fall. Despite boasting gross margins of 91.2%, which is absolutely elite by any standard, management just dropped a bomb in their forward guidance. They're signaling margin compression in Q1 2026, with operating margins expected to drop from 45% down to roughly 36%. Why? Strategic infrastructure reinvestment. They're pouring money into the foundation of the business at the exact moment Wall Street wants to see margin expansion. Even with a $1 billion share repurchase program authorized, which should theoretically support the stock, the market is treating this spending spike like a death sentence. The question is, are they destroying value, or are they building a moat that competitors can't touch? And that brings us to Reddit's secret weapon, something most social media platforms simply don't have and can't replicate. In a world drowning in AI-generated synthetic content, genuine human discourse is becoming the scarcest resource on the internet. Reddit has built what I call an AI moat through data licensing agreements with companies like OpenAI. They're selling raw, unfiltered human conversations for training large language models. This isn't ad revenue that fluctuates with economic cycles. This is high-fidelity, recurring revenue from a resource that literally cannot be synthetically manufactured. As AI companies get desperate for authentic human data, Reddit sits on the most valuable archive of genuine discourse on the planet. It's the ultimate hedge against an advertising recession, yet the market is completely discounting this strategic asset. So if the fundamentals are this compelling, why is institutional money running for the exits like the building's on fire? Welcome to the world of sector-wide derating. Firms like Evercore, Citi, and Morgan Stanley are slashing price targets, but not because Reddit's business is deteriorating. They're doing it because the entire social media sector is getting destroyed. When Snap collapses 50%, when Meta faces regulatory pressure, when digital advertising growth slows, the market forces every stock in the category to reprice regardless of individual performance. Reddit is caught in a structural re-rating where multiple compression is overpowering earnings quality. With a P/E ratio still hovering between 100 and 120 times earnings, the valuation bears have the upper hand in this tug-of-war. The market is essentially saying, we don't care about your 70% growth, we're not paying growth multiples in this macro environment. Now let's talk about what's actually happening in the trenches, because the price action tells a very different story than the earnings report. Right now, Reddit stock is what traders call a falling knife, and you know the old saying, never catch a falling knife. The stock breached its 251-day moving average at $183, which triggered systematic sell programs from quant funds and momentum algorithms. Sure, the RSI at 21.6 indicates the stock is severely oversold, but oversold can stay oversold for weeks when momentum has completely broken. Here's what should terrify you. There is no established floor yet, but it gets worse when you look beneath the surface at the hidden market mechanics. 61% of Reddit's trading volume is happening in dark pools and off-exchange venues. This isn't retail panic selling you're seeing on the charts. This is institutional stealth liquidation, where big money is quietly unloading massive positions without revealing their hand. Dark pool activity at this level makes true price discovery impossible, which means we could be one major block trade away from another violent leg down. But while retail investors are capitulating at the worst possible time, sophisticated money is already positioning for the bottom. They're just not doing it the way you'd expect. Large institutions are currently running what's called a volatility harvest strategy, selling put spreads to collect premium while waiting for the real entry point. They're not buying yet. They're betting on further downside with a break-even around $138. So where is the actual accumulation zone? The volume profile analysis points to $115 as the point of control, the price level with the highest conviction volume. Below that, we have a clear accumulation zone between $107 and $123. This is where smart money will likely build positions. Anything above $138 right now? That's chasing momentum on a stock that hasn't found its footing. So how do you know when the knife has finally stopped falling and it's actually safe to catch it? You need 3 specific confirmation signals before you even think about deploying capital. First, price must reclaim the $150 gap fill level on a daily close, not an intraday spike. This would confirm that the downtrend structure is broken. Second, RSI needs to recover from the low 20s back above 40, showing that selling pressure is exhausting and buyers are stepping in with conviction. Third, and this is critical, that dark pool ratio needs to drop below 50%. Signaling that institutional distribution has dried up, and we're seeing genuine price discovery again. Until all 3 of those conditions are met, the only rational play is to sit on your hands. Here's my strategic directive based on everything we've analyzed. Reddit has elite fundamental execution trapped inside a broken technical structure. The verdict is a definitive hold and wait. If you're already holding shares, you're in pain, but the business trajectory supports patience. If you're looking for entry, you've got 2 potential zones. The aggressive play is waiting for that $115 point of control, where you're buying with institutional volume behind you. The conservative approach is waiting for the 126 to 133 support floor to get validated with those 3 reversal signals I just mentioned. In this market environment, patience isn't just a virtue, it's the only way to avoid becoming exit liquidity for institutions that got in at the IPO. Before we wrap up, I need to hit you with the crucial reminder, because this is important. Everything you've heard today is for educational and informational purposes only. This is not financial advice, and I'm not telling you to buy or sell anything. All investments carry risk, including the potential loss of principal. The forward-looking statements and price projections I've discussed are based on current market conditions and technical analysis, but markets are unpredictable, and these targets could change rapidly. Reddit's business could accelerate beyond expectations or face unforeseen challenges. You need to do your own research, understand your risk tolerance, and ideally consult with a qualified financial advisor before making any investment decisions. So, what's the bottom line on Reddit? This is a company executing at the highest level, generating legitimate profits, and building an AI moat that most competitors can't replicate. But it's trapped in a sector-wide D-rating where fundamentals don't matter until the technical damage is repaired. Respect the trend, wait for confirmation, and don't let FOMO convince you to catch a falling knife. The opportunity will still be there when the setup is right. If you found this analysis valuable, smash that like button, subscribe to Smart Stock Sam for more deep dives on market disconnects, and drop a comment letting me know if you're watching Reddit or if you think I'm completely wrong on this one. I'll see you in the next video where we'll be breaking down another stock that has the market completely divided. Stay smart out there.